The number one risk of not investing in stocks, which can cost you all of your fortune. If you do not invest your money in stocks because you find it too risky, and at the same time feel that the cash or savings account is safe, you may be making a big mistake. The quota of people who directly or indirectly, for example via funds, own shares is just around 15%. That means 85% of the people do not own a single share. The main reason: stocks are far too risky. I disagree. My thesis: a broadly diversified, long-term investment in stocks is not only more profitable, but also more secure than a classic savings book or the daily allowance account. Why? I will prove it to you. There is a risk that most people overlook, and can cost them a fortune. Holding cash, the savings book and the daily deposit account are considered safe. Not least through the deposit insurance. In addition, there are no fluctuations in value. The $100 you save today will be $100 in a month and a year as well. The situation with stocks is different. You can bet on one stock and lose all of your money, although this can be avoided with simple means. If you invest $100 in stocks today, you have no idea how much it will be in a month. It can be $70, $100 or $130. So, are stocks riskier than cash after all? From the isolated point of view of fluctuations in value, yes. However, this view is very limited and ignores other, possibly much greater risks. One of them: the risk of inflation. You can put $100 in your savings account and after a year you still have $100. The big problem: these $100 no longer have the same purchasing power as at the beginning. And they will for sure not become more than $100. So, what is the problem? The problem is, the price level rises on average. We call it inflation. A shopping basket that is as representative as possible is compiled and how the prices have developed within a year is calculated. The result: the inflation rate. The European Central Bank aims to keep the inflation rate below but close to 2%. The long-term average inflation rate was 2 to 3% per year, with some outliers to 8% or even several thousand% during the German hyperinflation after World War I. In plain language, this means the shopping cart that costs you $100 today will cost you an average of $102 or $103 in 1 year. The consequence: your money is losing purchasing power. The nominal value will be the same, $100, but the real value, which represents the purchasing power, has decreased. This graph shows how the purchasing power of $100 has changed since 1900. It decreased from $100 to less than $3.50. As you can see, cash has almost continuously lost its value. At a constant price level, today's purchasing power is only around 3% compared to 1900. If we think these findings into the future, we get the following scenarios, depending on the inflation rate and investment horizon. How much will $100 or euros be worth in N years? If you decide today not to invest your money but to leave it in the savings account, one thing is certain above all else. You will not lose any money in nominal terms, but your real purchasing power will decrease enormously. Incidentally, even a daily deposit account doesn't help much. The financial broadcaster Bloomberg examined the real interest rate, equals nominal interest rate, inflation rate, in Germany from 1968 to 2016. The result: savers lost 0.16% per year on average. This situation is not a result of the current low interest rate environment. In phases when interest rates were higher, the majority of inflation was so high that it wiped out most of the income. That is why protecting against inflation may be more important than ever. By this point you should have understood that every dollar in your checking account or savings book will lose value. Every day. Now you could argue, all right, but these few percent a year don't make much of a difference. For one thing, a few percent a year is a lot in the long run due to compound interest. In addition, there is another phenomenon that we know from the past as well as currently, for example, from Venezuela: hyperinflation. A phase in which inflation is not just 2 to 3% per year, but 100%, 1,000% or even more than 10,000%. Here is an example from German history. In May 1923 a kilo of bread costs 474 marks in Berlin. 2 months later the price rose to 2,200 marks, at the beginning of October it was 14 million. Another 4 weeks later the loaf of bread costs 5.6 billion marks. Applied to the present day, this means someone who has $1 million can use it to buy a fancy house in a good location. And 6 months later he only gets a slice of bread for the same money. He lost all of his fortune. And such hyperinflation is not a phenomenon from days gone by. Since the 1990s, the monthly inflation rate of over 100% have been observed regularly in individual countries, including Brazil, Argentina, Zimbabwe, Russia and others. The most recent example is Venezuela, where the daily inflation rate is 6% on a regular basis. Hyperinflation is a real scenario. It is primarily triggered by a failed monetary policy or a monetary policy that has gotten out of hand. Are you so confident in the world's central banks that you don't believe that hyperinflation like this could ever happen within the next 50 years, even if it is only 20% a year? Well, even if I think that the gentlemen are doing an incredibly difficult, ungrateful and often underestimated job, I don't have this trust. Especially in light of the past policy of historically low interest rates and a sharp increase in the money supply. This is a risk that hardly any economist in the world disregards. How stocks reduce the risk of inflation and increase your purchasing power. So how do you protect yourself from hyperinflation? The principle is, if the money is devalued, you have to revalue it. That means, achieve a positive return that offsets or exceeds the inflation rate. In addition, stocks are an excellent, if not the best, asset class. Shares are company shares. Companies consist of real values such as raw materials, machines, land, real estate, products and much more. Last but not least, companies are the central switching points that increase prices. If a raw material price doubles, a company can double the prices and thereby keep the profit margin largely constant. So how did stocks perform compared to other asset classes, including cash, after inflation? The blue line represents the purchasing power of stocks, what is commonly referred to as risky. The dark green line is 10-year government bonds. And the gray line is the purchasing power of cash, here the US dollar, which is commonly referred to as safe. Choose which line is the safest for you. If you ask me, cash looks like a pretty expensive security. That is in my opinion the main reason why stocks are safer in the long term than cash, savings accounts or daily deposit account. One thing is clear, a single stock does not give you any protection against inflation because it is exposed to many other factors. But a broadly diversified investment in the stock markets does. However, this does not happen annually. There are factors that cause stock markets to fluctuate in the short term. That is also the reason why it is hardly possible to achieve one-to-one inflation protection with stocks. There is no one-to-one protection there either, since such extreme phases naturally lead to general uncertainties, but share prices rise nonetheless. For example, the authors at Wikipedia state in relation to the aforementioned German hyperinflation, the stock index of the Reich Statistical Office rose in December 1923 on a monthly average to a value of 26.89 trillion points. Just for the sake of clarity, previously, the index, which reflects an average of the share prices, was around 100 to 1,000 points. That means, the share prices have multiplied in the phase of hyperinflation and preserved a large part of the assets. The sentence that I would never have believed in before. Yes, stocks fluctuate in value, and they will continue to do so. And yes, there is a risk. However, this risk can be minimized. In addition, you can drastically reduce the risk of inflation and also benefit from opportunities. Companies are productive actors and represent the economy. They drive economic growth, increase in value with the rate of inflation and generate profits, which they distribute to a considerable extent. Together, these are the three reasons why stock markets will rise over the long term. And they will not only increase, they will increase by at least 99.9% at the level of the inflation rate or more, and thus not only maintain your purchasing power in the long term, but even increase it. That makes stocks great investments. Not only because of the return, but because, despite higher fluctuations in value, They protect much better against inflation than the most popular investment among Germans, the savings account. That is why I can sleep more peacefully when a large part of my money is smart, broadly diversified and invested in stocks over the long term instead of in the savings book or the daily deposit account. And many years ago I would not have thought myself that I would say that one day.